Welcome to the Deep Dive. Today we're taking a closer look at Copart Incorporated, specifically their fourth quarter and full fiscal year 2025 earnings call results.
Yeah, we're going to break down the financials, the strategy, what management said, and basically give you the key takeaways so you get the picture without, drowning in the numbers.
Okay, let's kick things off with the headline numbers for Q4 fiscal year 2025. Copart reported GAAP EPS of $0.41.
Which is a nice beat, right?
Yeah, notable beat against the consensus estimate, which was $0.37. So that's $0.04 higher, an impressive 10.8% beat there.
But on the flip side, Q4 revenue, it came in at $11,125.1 million. That was actually a slight miss versus the consensus of about $11,146 million.
Right, a little soft on the top line compared to expectations.
Exactly, though it's still up year over year, a solid 5.2% increase. But despite that revenue miss, the profitability was, really robust.
Right.
Gross profit jumped 12.4% year over year to $509.7 million. That pushed the gross margin up to around 45.3%.
Wow, that's a strong margin.
It is, and net income also got a big boost, climbing 22.9% year over year to $396.4 million.
And looking at the full picture, the full fiscal year 2025.
Yeah, strong growth across the board. Revenue hit $4.65 billion. That's up 9.7%. And diluted EPS came in at $1.59, a 13.6% increase. It was actually a record year for them in units sold, revenue, and operating profit.
Okay, so strong results overall, especially on profitability. How did the market react initially?
Well, right after the call started, there was some positive buzz. Headlines mentioned an after-hours price bump, but then later in after-hours trading, things got a bit choppy. It seems like investors had a sort of mixed read on the near-term volume numbers, even with the really strong pricing and profit figures.
So maybe some caution about future volume despite the current strength.
Possibly, but I'd say overall, factoring everything in, the sentiment still leans, constructively bullish.
Okay, let's unpack this a bit more then. Digging into the details, where did that profitability strength really come from?
A lot of it was driven by their service revenue. That grew a healthy 7.1% year over year, reaching $956.2 million.
And how did that compare to, say, vehicle sales?
That's the contrast. Vehicle sales revenue actually saw a 4% year-over-year decline, down to $168.9 million. So you can really see the service side is where the leverage is.
Got it. And you mentioned strong pricing.
Oh, absolutely. This is really key, I think. Copart's pricing power is undeniable. Their global average selling prices, the ASPs, they rose by an impressive 5.4% in Q4.
And in the U.S. specifically?
Even stronger. U.S. insurance ASPs increased by 5.7%. And management, they really emphasized this point. They said Copart's ASP growth eclipsed that of used vehicle value indices like Manheim.
And Manheim's the big benchmark for wholesale used car prices, right?
Exactly. So they're beating the benchmark. And they added it grew at a rate more than fivefold that of service providers similar to ours.
Wow. So that's not just market lift. That's significant outperformance.
Yeah.
Real pricing leverage.
It really speaks to their auction platform, the liquidity, the global reach. They can command those prices.
And it wasn't just operations driving the bottom line, was it?
No, good point. They also got a boost from increased interest income. That was $49.8 million, up 14.6% year over year, basically benefiting from putting their cash pile to work in Treasury securities.
So optimizing on multiple fronts. Okay, let's talk volume then. That seemed to be the area with maybe a bit more nuance.
Yeah, there's an interesting story there. So for the full fiscal year, global insurance volumes were up 4.5%. Pretty decent.
Okay.
But Q4 specifically saw a modest decline, 1.9% globally, and U.S. insurance volumes were down 2.1%.
So a slowdown in the back half of the year, what did they attribute that to?
Management talked about the ebbs and flows of business activity among individual auto insurance carriers. Basically, insurers adjusting their strategies, maybe pulling back slightly as they focus on profitability.
Makes sense. We've seen insurers dealing with rising costs.
Yeah.
Right. And they also mentioned shifts in the uninsured and underinsured motorist populations. This seems linked to those big hikes in insurance premiums we've all seen. They cited a 4.3% decline in something called earned car years for Q1 2025 versus the prior year.
Okay, explain earned car years for us.
Sure. It's basically the total time insurance coverage is active over a period. It's a way for insurers to track their active customer base. So even though the total number of cars on the road grew, fewer of them were actively insured for the full period, suggesting some people might be dropping coverage due to cost.
Interesting. That definitely adds context to the volume picture. Was there anything else impacting the reported unit sales?
Yes, and this is important strategically. Copart is making a change. They're moving low-value non-insurance units away from their usual Copart Direct channel
Okay, where are they going?
to a new direct-buy peer-to-peer channel. Now, the key thing here is this shift reduces the number of reported units sold because these aren't counted in the traditional metrics anymore.
So the numbers look lower, but it's a strategic choice.
Exactly. It significantly improves efficiency because they avoid the costs of transporting and storing these lower-value vehicles. If you actually normalize for this change, U.S. units only declined by 0.6% in Q4, not the 2.1% initially reported for insurance.
That's a crucial detail. Shows they're focusing on profitable units and efficiency, not just raw volume in every segment.
Precisely. And speaking of efficiency, inventory management was another strong point.
Oh, yeah. What did they report there?
Global inventory was down 13.1% year over year. U.S. inventory down even more, 14.8%.
How did they achieve that?
Faster cycle times, basically moving cars through the system quicker, clearing out older inventory, and they also saw low single-digit declines in assignments.
Assignments being the cars assigned to them by insurers.
Right. And management stressed that assignments are actually a better predictor of future sales than just looking at the static inventory level on any given day, so watching assignments is key for you.
Good tip. What about international operations?
That was a definite bright spot. In Germany, for instance, they shifted insurance units from purchase contracts over to consignment. That helped drive international gross margin expansion.
And their other businesses? BlueCar, Purple Wave.
Also doing well. BlueCar, which handles vehicles for banks, rental companies, fleet partners, their units grew 15.3% in fiscal 25. And Purple Wave, the heavy equipment platform, saw its gross transaction value, or GTV, grow 9.4% for the year.
That's impressive, especially for heavy equipment, given the macro caution.
Yeah, they said it significantly outpaced the industry. Shows those adjacent businesses are contributing nicely.
Now, they must be investing to support all this growth, right? What about costs?
They are investing. Facility-related costs were up 3.2% globally in Q4, and U.S. per unit costs rose 5.4%.
Should we worry about rising costs?
Management frames this as necessary investment. They're expanding operational capacity, more yards, better logistics to handle future growth. So it's more of a growth investment than a sign of runaway costs.
Makes sense. Okay, let's shift gears a bit. Technology AI that's everywhere now. How is Copart using it?
Extensively, it sounds like. AI is widely deployed, according to them. It's being used for decision support tools, especially for their sellers, like insurance carriers.
Oh, so?
It helps them make instantaneous total loss decisions. The AI is fed with data from millions of similar vehicle sales and uses, current-gen large language models to provide those insights.
So speeding up the claims process for insurers.
Exactly. And making it more data-driven. AI is also being used in customer and agent support, improving interactions, and at the auction level itself for things like product recommendations and search results.
What's the overall goal with AI?
They expect it to make operations radically more efficient. They want to compress cycle times for clients and even for their own internal processes, like their Title Express service, which helps get titles faster. It seems deeply integrated.
Interesting. What about electric vehicles? We hear so much about repair costs and complexity there. How does that impact Copart?
Management commented that the returns on EVs are very strong. And interestingly, they said EVs total, if anything, more easily.
More easily. Why is that? Is it the batteries?
Not necessarily the battery or the drivetrain itself, although those can be factors. It's often because EVs are packed with advanced tech, next-gen sensors, adaptive headlights, complex camera systems.
Right, all that calibration stuff.
Precisely. Damage to those components often needs specialized, costly repairs, advanced calibrations, reprogramming. It just makes it much more likely the repair cost will exceed the threshold for a total loss.
So EVs, ironically, are becoming a tailwind for salvage auctions like Copart.
It seems that way. More complexity equals higher repair costs equals higher total loss frequency.
And what about fully autonomous vehicles like Waymo?
Management said they currently have a de minimis effect, basically negligible impact right now. Their operations are still quite limited geographically, and they often have different insurance setups. So EVs, yes. AVs, not really yet.
Okay, let's pivot to the balance sheet and capital allocation. They sound like they're in a strong financial position.
Extremely strong. They ended the quarter with about $6 billion in liquidity. That breaks down to $4.8 billion in cash and held-to-maturity securities, plus available capacity under their revolving credit facility.
That's a lot of firepower. How do they think about using it? Returning cash to shareholders, M&A.
Their long-term approach focuses on returning cash, primarily through share buybacks. Historically, they've done this via structured tenders or just buying on the open market.
And M&A. Are they hunting for deals with all that cash?
They're always looking, but they seem disciplined. They evaluate deals on two fronts. Is it a good investment on its own? And does it fundamentally enhance what Copart already does, or can Copart enhance it? Management specifically said the cash doesn't per se inform an M&A strategy.
Meaning they won't just buy something because they have the cash lying around. It has to fit strategically.
Exactly. A disciplined approach, which investors usually like to see.
Okay. They didn't give formal guidance, but did they discuss any broader macro trends relevant to their business?
They did. A key one is total loss frequency. It continues its long-term upward trend. They cited U.S. Q2 2025 figures at 22.2%, which is up from 21.5% a year ago.
And that's driven by?
Increasing vehicle complexity and rising repair costs, like we talked about with EVs. Even if overall accident rates decline, the cars that do get damaged are just more likely to be totaled. They see this as a structural tailwind for salvage supply.
More total cars means more business for Copart.
Fundamentally, yes. They also acknowledged the cyclical ebbs and flows in insurance behavior we touched on earlier, like consumers potentially pulling back on coverage due to high premiums. But they view that as cyclical, not a permanent shift.
What about things like hurricanes, CA events?
They mentioned the unpredictable nature of hurricane season. While big catastrophic events obviously drive a lot of activity for them, they noted these aren't necessarily per se profitable on a fully loaded basis. It's more about providing a critical service during those times.
Right, being there for their insurance clients. Exactly. It strengthens relationships.
Mm-hmm.
And one last point. As insurers' profitability improves, maybe their combined ratios get better. The ratio of claims and expenses to premiums.
Right. As that improves, insurers might get more competitive with each other, balancing growth versus profitability. Copart's plan is just to keep delivering the best auction returns and service to navigate that competitive landscape.
Okay, so pulling this all together for you, our listener, thinking about this from an investor's perspective, what's the main takeaway?
I think what really stands out is Copart's core strategic story. It's all about pricing power, and that power comes from their unique digital platform and, importantly, their global auction liquidity.
That network effect with all the buyers.
Precisely. They have around 300,000 paying members, lots of international buyers. That allows them to consistently get those superior average selling prices we talked about.
And that pricing strength, plus the operational tweaks like the direct buy shift and the international consignment moves.
Yeah, that's what translated into the really strong gross margin expansion and record profits. Even though Q4 revenue was a touch light and volume softened a bit, it shows they're really managing the business for profitability.
And looking forward, those long-term trends seem supportive.
Definitely. The structural trend of rising total loss frequency, the impact of EVs making cars harder and more expensive to fix, plus their strategic use of AI, it all provides a pretty strong foundation for future growth. These aren't just short-term blips.
It's also worth remembering that context from HSBC, right? Before the call, they upgraded Copart to buy, targeting $62.
Yeah, and their reasoning was basically seeing the volume softness as temporary while highlighting the margin levers Copart has. That helps frame why the overall sentiment, despite some mixed signals in after hours, remains kind of constructively bullish.
So for you tracking this closely, what should you be watching?
Keep an eye on those high-frequency indicators. Things like assignment volumes or insurers sending them more or fewer cars. And track those ASPs. Are they maintaining that pricing power? That will give you the best real-time pulse on volume and price trends.
All right, perfect. Let's shift gears now into our favorite segment, the not financial advice zone. Time to get a little creative.
Okay, disclaimer up front, these are purely thought experiments, potentially outrageous, but maybe plausible ideas based on what we've discussed, not recommendations.
Absolutely. What's your first idea?
Okay, trade idea 1. Go long Copart and short a basket of auto insurers, specifically those known for high repair payouts.
Interesting. Explain the thesis.
It's pretty simple, really. Copart directly benefits from everything that pressures traditional auto insurers. Rising total loss frequency, complex vehicles, high repair costs. While insurers might have good quarters here and there, The long-term trend seems to favor totaling cars over fixing them.
So you're hedging the friction in the system.
Exactly. You're betting that as insurers struggle with repair costs, especially for EVs, they'll have to lean more on the total loss option. That drives volume and higher ASPs straight to Copart. The short basket would target insurers maybe with higher historical repair ratios or those exposed to high-cost states.
That definitely captures the dynamic we've been discussing. What's the counter-argument or the biggest risk there?
Well, the main risk would be if something fundamentally changes that trend. Maybe a breakthrough in repair tech makes fixing complex cars suddenly cheap, or insurers get radically better at managing repair costs. Seems unlikely right now, but that's the risk.
Okay, provocative. What's idea number 2?
Idea 2, long CPRT, funded by taking a cautious view on broader infrastructure.
Okay, unpack that one for me. Long Copart, funded by selling, puts on an infrastructure ETF.
Something like that, yeah. Hear me out. Copart is investing heavily in its own infrastructure, expanding yards, improving logistics. That's part of their operational leverage story. So we want upside exposure to that, maybe through call options or call spreads, betting their ASPs and margins keep outperforming.
Right, betting on their specific network build-out.
Exactly. Now, to potentially fund that bullish Copart view, we could sell out of the money puts on a broad infrastructure ETF, like XLI maybe. The thinking is, while Copart builds its specialized network, general infrastructure spending might face cyclical headwinds or policy uncertainty, maybe depressing those related stocks.
So you're saying Copart's infrastructure is an alpha driver, distinct from general infrastructure trends.
That's the bet. You're trying to monetize potential softness in broad infrastructure to gain exposure to Copart's very specific, high-return physical network expansion. It's a relative value play, in a way.
Definitely creative ways to think about the interconnectedness there. Okay, let's wrap things up.
In summary, Copart's Q4 and full-year results really show a company playing to its strength. They're using that unique digital global auction platform to get great pricing and deliver strong profits.
Yeah, while there are some short-term volume things to watch and those strategic shifts like direct buy, the bigger picture seems positive.
Right, those structural tailwinds, rising total loss frequency, vehicle complexity, EVs, their use of AI, they all seem to position Copart well for the long haul.
So here's a final thought for you to chew on. As our cars get smarter, more complex, maybe even drive themselves eventually, are we just making them destined for the salvage yard faster? Does that make companies like Copart an increasingly essential, almost unavoidable part of the whole automotive lifecycle?
That's a deep question. Definitely something to ponder. And remember, everything we've discussed here on this deep dive is for informational purposes only. It's not financial advice.
Please always do your own research and due diligence. Thank you for joining us on the deep dive. We always appreciate you listening and hope you found this breakdown insightful.